Hello, we're here to study SLP and we'll start by the charts. This is the all history chart going back to the company's IPO in 2005 or so. Well, this was a dead small cap until December 2006. We had this huge bull run from about $3 to 16. So a 400% plus rise in just 1, 2, 3, 4, 5 months, and the stock now is pulling back. Let's check the short-term chart. Yes, it's pulling back. It is a bit below this level 1361 now, and let's just do this. And perhaps it will touch the 50 days moving average support here at about 10, and the 200 days moving average is coming up, but just at about 5.5 or so. So there's technical potential here for a serious breakdown, a correction I mean, because the trend would remain bullish even if the stock would come down to touch the 200 days, the long-term trend of course. Now let's check the fundamentals. This is the number of shares outstanding on an historical basis and market cap. The market cap is at near a new all-time high at $105 million, and the share count has remained more or less stable over the years, rising just 1.4% on average since 1997, and the market cap is growing 22% since 97 too. It was just 14 million here, 3 million in 1998, and 105 million now. As for the balance sheet, we have here long-term debt and current ratio. Long-term debt is 0, and the current ratio is quite healthy here at 5.4, and almost more than 60% of total current assets is cash and marketable securities. So this balance sheet is very healthy. As for revenues, that with the balance sheet means I'll consider a low dilution factor in my valuation model. We'll get to that next. As for revenues, well, there wasn't much growth here between 1999 and 2005. You see, the 1999 revenues were 3.5 million and 2005 revenues were 4.75 million. But now the revenues are growing. You can see this upward trend, and there were 5.86 million in fiscal 2006, and then one analyst is expecting 7.85 million for 07 and 9.7 million for 08. So considering a base of 2005 when revenues hit this low level of 4.75 million, until 2008, revenues are expected to grow 28.6% on a compound average growth rate of 28.6%, and the industry grew 16% from 2005 levels. Gross margin for SLP is 81.6%, and the industry average is lower at 58.1%. But the problem here is the price to sales ratio is very high for SLP at 13.4. So the company's value is 13 times more than 1 year's revenues, and I've considered 2007 for this calculus, not 2006, or it would be even higher, and the industry average is just 2.82. As for earnings per share and net profit margin, well, the earnings per share have been pretty erratic here. You can see losses in 97, 98, 99, 2000 and 2001, then small profits, a nice profit here in 2003 of 33 cents, but I believe that is due to some exceptional benefit. And analysts' earnings per share in 2006 was 8 cents, and the analysts are expecting 18 cents for 07 and 28 cents for 2008. Net profit margin was very negative here, and now it is quite high. It was 11.6% in 2006, and expected for 07 26%, and for 05 about 25%. So I'll consider 25% as my net profit margin estimate. The price to earnings ratio you can see here is extremely high at 75, and the industry average is 30.4. So let's study this valuation model. Well, the yellow lines, as you know if you've been following my analysis, are known facts. These orange lines are calculated automatically by the model, and I just have to estimate the white lines to get to the end results. So for the dilution factor, since the historical share count compound annual growth rate was just 1.4% and the balance sheet is very healthy, I consider just 1% going forward. And as for the revenue compound annual growth rate, I put here 1.3, which means 30%. The one analyst covering the stock is expecting just about 28%, so more or less the same. Final net profit margin, 25%, and the earnings per share multiple estimate of 30.4, which is the industry average. And with all this, the results I get is the stock will be at 12.3 in 2009. So the model is expecting the share price compound annual growth rate between now and 2009 to be minus 3% going down. So the stock would only be very attractive to buy at, attractive, giving a 16% return at 7.88. Since the stock is trading at, let me see here, at 13.35, I don't consider it attractive, not attractive. So on a 1 to 10 scale, my rating is 4. But I really like the company, but it is very small now and it is overvalued. Thank you, bye.